Hello, today we are going to discuss how to manage your investment risks. Ever wondered what could possibly go wrong when you invest your hard-earned money? Well, let's dive right into it. Each investment you make carries a certain level of risk. But what exactly is this risk we're talking about? Investment risk, in essence, is the probability or likelihood of occurrence of losses relative to the expected return on your investment. It's the potential that your decisions will not pan out as planned, and as a result, you might end up with less than what you initially put in. These risks can significantly impact your return on investments, leaving you with less than what you had hoped for. Now, this might sound a bit daunting, but understanding these risks is a crucial part of successful investing, because by getting a grasp on them, you can better manage your investments and steer your financial ship towards the horizon of success. But don't worry, there are strategies to manage these risks effectively. So, what is risk management in investments, you may ask? Well, imagine you're setting sail on a voyage. You wouldn't just hop on a boat without checking the weather, would you? Of course not. You'd want to understand the potential storms you might face and how to navigate them. This, in essence, is what risk management in investments is all about. Let's break it down. Risk management in investments is a systematic process that involves identifying, assessing, and prioritizing risks associated with your investments. It's about understanding the potential downside, the storms that might be brewing, and planning your course of action accordingly. However, the aim of risk management isn't to eliminate risk entirely. That would be like trying to eliminate all storms from the sea. Impossible and, frankly, unnecessary. Instead, the goal is to reduce, monitor, and control the probability or impact of unfortunate events or risks. Let's simplify it further. Picture risk as a flame. A flame in controlled amounts can be useful. It can cook your food, keep you warm. However, an uncontrolled flame can lead to a devastating fire. Risk management, then, is about keeping that flame in check, ensuring it's useful but doesn't become destructive. It's important to note that risk management isn't a one-time task. It's an ongoing process, much like checking the weather throughout your voyage. You need to constantly monitor and reassess the risks as market conditions change and adjust your strategies accordingly. So, you might be wondering, how do you actually manage these risks? Well, there are several strategies that investors can use, each with their own benefits and drawbacks. Some of these strategies include diversification, asset allocation, and regular portfolio review. Remember, the key to effective risk management is not avoiding risk entirely, but understanding it, controlling it, and making it work in your favor. Because at the end of the day, investing without risk is like sailing without wind. You won't get very far. Now that we understand what risk management is, let's delve into the strategies. Ever heard the saying, "Don't put all your eggs in one basket"? This is the essence of diversification, a crucial risk management strategy. Diversification is about spreading your investments across different asset classes. Think of it as a financial buffet. You wouldn't pile your plate with just one dish, right? Similarly, investing all your money in a single stock or sector may seem tempting when it's performing well, but it leaves you vulnerable to significant losses when that specific stock or sector takes a hit. Instead, consider investing in a mix of stocks, bonds, real estate, or even commodities. Each of these asset classes performs differently under varying economic conditions. So, when one asset class is down, another might be up, balancing out your potential losses. It's like having a safety net for your investments. Diversification is just one strategy. Let's explore another one. Asset allocation is another powerful strategy in managing investment risks. It's like a balancing act where your investments are spread across different asset categories such as stocks, bonds, and cash. The idea here is not to put all your eggs in one basket, but rather in several. Each asset category has its own level of risk and potential return, so by investing in more than one, you're effectively spreading and therefore reducing risk. For instance, when one asset category may be performing poorly, another might be doing well. This helps to offset potential losses. The importance of this strategy lies in its ability to help you reach your financial goals while minimizing risk. It's about finding the right mix of assets that aligns with your risk tolerance, investment horizon, and financial objectives. Remember, there's no one-size-fits-all approach to asset allocation. It's a strategy that should be tailored to your individual circumstances and needs. Well, we've covered diversification and asset allocation, but there's another strategy you should know. Regular portfolio review is yet another effective strategy that helps in managing investment risks. This approach involves frequently checking on your investments to ensure they remain aligned with your desired risk level and investment goals. You see, markets are dynamic. The value of your investments can fluctuate due to a myriad of factors, from economic changes, industry trends, to company-specific news. So your portfolio that was once well diversified can become unbalanced over time. That's where regular portfolio reviews come in. By continually assessing your portfolio, you can identify any deviations and make necessary adjustments. This could mean selling off some shares from an overperforming sector or buying more from an underperforming one. Regular reviews also allow you to reassess your investment goals. Maybe your risk appetite has changed, or your financial goals have shifted. By reviewing your portfolio, you can make sure it continues to reflect your current needs and aspirations. So, these were some of the key strategies to manage investment risks effectively. To quickly recap, managing investment risks is crucial for successful investing. We've delved into 3 key strategies that can help you safeguard your investments. Diversification, which is all about not putting all your eggs in one basket, allows you to spread your investment across different asset classes, sectors, or geographical regions to reduce risk. Next, we touched upon asset allocation, a strategy that involves dividing your investment portfolio among different asset categories like stocks, bonds, and cash. This strategy depends on your financial goals, risk tolerance, and investment horizon. Lastly, we explored the importance of regular portfolio reviews. This strategy helps you to realign your investments as per changing market conditions and personal financial goals. Remember, smart investing is not just about making profits, it's also about managing risks. Don't forget to like, share, and subscribe for more investment insights. Until next time, keep your investments safe.